In this lesson, we're looking at the various costs associated with purchasing a home. There's many extra costs you need to consider when deciding to buy a home as opposed to rent an accommodation. And some of those things I've listed here. So you would need a down payment, which is a percent of the home value that you pay up front. If that value is less than 20% of the purchase price of the home, you also need mortgage insurance. You need to pay HST if you build a new house. There would be lawyer fees, land transfer tax, property tax, a home inspection fee, service connection fees. The cost of any repairs or renovations would be yours. And in addition, if you're purchasing a home for the first time, you would also need to buy things like appliances, furniture, window coverings, tools, lawnmower, step ladders, etc. All of those things you need if you own your own home. So we're going to go through a couple of examples here. The first one says, Cam and Sarah have owned a 3-bedroom home for 12 years. They make weekly mortgage payments of $214.88, quarterly payments of property taxes of $945. They have a separate bank account for home repairs, and they put $250 into that account every month. They receive bills for electricity, natural gas, water, home insurance, satellite TV, telephone, and internet, and the average monthly total for those expenses is $560. Calculate their total annual expenses associated with their house, rounded to the nearest $1,000. So let's break this down and figure out the total for the different categories here. So for their mortgage, it says they make weekly mortgage payments of $214.88. That means they would make 52 such payments in a year for a total of $11,173.76. Now, for property tax, it says they pay $945 quarterly. So that's 4 times a year. So 945 times 4 is $3,780. Then for repairs, they save $250 a month for any unexpected repairs that come up, which is a great idea. So that is $3,000 a year. And then there are added expenses of electricity, gas, water, insurance, etc. Total $560 monthly for a total of $6,720. So their total annual expenses come to $24,673.76. The next example says the Armstrongs have a combined annual income of $95,000 and they make monthly mortgage payments of $1,200. Their utility expenses average $375 a month. Calculate the total percent of their total income that they spend on housing. So first, let's figure out how much they spend on their mortgage annually. So they make monthly mortgage payments of $1,200. So $1,200 times 12 tells us that in a year they pay $14,400 towards their mortgage. And for their utilities, they average $375 a month for a total of $4,500 annually. So their annual expenses associated with their home are $18,900. So the question is asking, what percent is that of their total income? So we need to know what percent is $18,900 of $95,000. So we take $18,900, divide it by $95,000, their total income, and multiply by 100. And that gives us about 19.89, so approximately 20% of their income. And that concludes this lesson.